Well, good morning and welcome to the Experian Quarterly Business Credit Review for Q3 2021. My name is Gary Stockton. I'm with Experian. And if you would like to follow along or just keep a copy of the slides, we have dropped a PDF in the handouts area. We'll also include a link to the recording and the slides in our follow-up email. During today's webinar, we'll be discussing key findings in the Experian Moody's Analytics Main Street Report for Q3 2021. The review will be presented in two segments. Presenting for Experian is Brody Oldham, Vice President of Commercial Data Sciences. And from Moody's, we have their Deputy Chief Economist, Christian DeRittis. To make sure you get the most value out of today's session, getting answers to your questions, we encourage you to raise your hand by submitting your questions using the Q&A tool in the GoToWebinar applet. We'll try to leave time for a few questions at the end. And now I'd like to turn things over to Christian from Moody's Analytics.
So what I've prepared today are a number of slides providing an overview of the economic conditions as we see them today. And I'll talk a little bit about our outlook, our baseline outlook for the economy over 2022 and into 2023. I'm talking both about economic conditions as well as what we see for small businesses and small business credit. And then finally, I'll end my comments here with some remarks about the key risks to the forecast. There certainly are several things we can worry about, and I will highlight a couple of those. What are things that might go wrong that could take the forecast in a different direction, and I'll end on a positive note with some things that might go right that could take us in a more optimistic direction. We'll leave time at the end for questions, certainly after Brody's section, so do please feel free to fire away with those questions. Always look forward to hearing what you'd like to discuss. But with that, let me go ahead and I'll actually this quarter I'll start just by throwing out a few numbers. Some of the feedback I've gotten in the past is that some of you out there would just like to hear the numbers up front. So let me give you three key economic statistics and our forecast, our baseline forecast. That'll help you understand where we're headed. So GDP, gross domestic product, we forecast will come in at 5.5% this year for 2021. So when all is said and done and we tally up how much the economy grew this year, we expect 5.5%. That's certainly a market improvement from the contraction that we had in 2020, that negative 3.4% contraction. So the economy certainly did come roaring back here, and we see quite a bit of expansion. For next year, we expect 4.5% growth, which is a bit weaker, of course, but still very strong from a historical perspective. The unemployment rate is currently at 4.2%. Last year was 6.8% at this time last December. So we made great progress in employment this year, bringing more people back into the labor force. Expect that to continue and actually accelerate from what we've seen most recently. And I'll talk a little bit about those trends in a moment, so that by this time next year, we could see an unemployment rate that is closer to 3.5%, very close to what we had prior to the pandemic when the labor market was actually humming along. And then finally, the 10-year Treasury, a very important metric when it comes to interest rates for a number of the folks on the line here, financial institutions, banks, of course, very keen to understand where interest rates are headed. We're at 1.5, close to 1.5%. I'm rounding here on the 10-year Treasury today. That's up from 0.9% last year at this time. So we actually had 10-year rates below 1% last year, you'll recall. Next year, expect some increases, certainly, as investors become a little bit more concerned about inflation and expansion of the economy here, but still expect a fairly modest increase to 2.3% by this time next year. All right, so that the level set gives you my baseline. With that, let me dive into some of the statistics and the assumptions that support that baseline, or at least justify that baseline outlook. The first piece of data I'd like to present to you is so-called back to normal index. This is an index I've shown in the past on these calls. Essentially, it's a combination of wide variety of real-time economic indicators. So this includes not only government statistics like the unemployment rate, employment growth, or the GDP, but a number of more real-time information such as smartphone mobility, the number of people going to restaurants, number of people going to amusement parks or movies, among people traveling through TSA checkpoints. So it's the index here is really designed to capture fluctuate, really day-to-day fluctuations in economic activity as best we can using these other data sources as proxies or approximations of where the economy is. As you look at the index going back to March of 2020, and I should say that the 1st of March is indexed to a value of 100. So we call it a back to normal index because we're trying to track the economy's progression back to that pre-pandemic level of activity. You can see the trajectory of the pandemic, initial lockdown, sending the index to a very low level, some reopening, leading to some additional activity. So we were able to get back maybe about half of the way back to where we were. In 2020, we moved sideways, and it really wasn't until early in 2021, this year, that we saw the economy really start to accelerate back towards its previous levels of overall activity. Everything was going smoothly until the Delta wave hit, and at that point, you can see the economy stalling, really seeing this index moving sideways for a number of months. The good news here to read into that is that although we had infections and COVID hospitalizations rising throughout this time, the economy overall actually was fairly resilient. People have, by and large, have learned to live with the pandemic situation. And so we didn't see the economy really backtrack. We just didn't see it continue its upward trajectory. Delta declined, but now we have the Omicron variant. Lots of concerns or predictions about a similar type of trajectory. Our view is that waves of COVID are going to continue. That's baked into our baseline. But adaptation is widespread among households and businesses. So first of all, we need to better understand the Omicron variant itself in terms of both infectiousness and the severity. At this point, it looks as though it is more infectious than Delta, but perhaps not as severe for those who contract COVID, the Omicron variant of COVID, but that we still need more data on that. From an economic standpoint, though, we do see that the economy seems to be humming along. People are modifying their behavior, sure, maybe taking fewer flights or maybe not making as many trips, but adapting relatively well. So our outlook, certainly in the short term, is perhaps for some pullback in affected industries like airlines or even restaurants, but by and large, we don't expect to see the economy really backtracking to a significant degree. We move to the next slide here. Back one. In terms of the labor market, obviously very important for households. We can see a pattern of job growth this year that is very similar to that back to normal index. Earlier in the year, we saw very significant job gains. We were adding a lot of jobs throughout the early part of the year. Again, I attribute much of that to the vaccination campaigns, people feeling more comfortable, wanting to get out and re-engage with the economy. In the early summer, June, July, you can see we added close to 1 million jobs in each of those months. So really lots of activity. Then Delta hit and we saw some pullback, a bit of a pause in the job growth. But the job growth was still positive. So things kept moving in the right direction, perhaps at a slower pace though, as we took a moment to assess this Delta variant and what it meant. More recently, you can see that for the month of November, job growth paused again. It actually backtracked in terms of its level here. We had only 210,000 jobs in the month of November, according to the BLS. However, I am suspicious about this number. I think there are a number of measurement error issues, or a number of measurement issues in the data at the moment when it comes to the number of businesses responding to surveys or the seasonal adjustments that we are making to data. The pandemic has wrought a lot of havoc in terms of what it means to seasonally adjust data. We had shopping, for example, occurring much earlier in the holiday season this year, given supply chain concerns than what we had in previous years. So I wouldn't be surprised if this number gets revised upward. It's also inconsistent with a lot of the other labor market data that we see. There's still quite a bit of demand out there for workers, and we do see other measures of labor market activity actually showing stronger job growth. Nonetheless, it might not be as strong as we would want. So it's certainly something we want to keep an eye on as we think about the pandemic itself. But I do suspect the economy will continue to add jobs going forward. Perhaps as the pandemic does come back under control, we should see more and more people re-engaging with the labor market. If they're out sick now, fewer infections going forward, given vaccinations and additional boosters should lead to additional job growth in the months ahead. Let me dig a little bit deeper into that. In terms of the sectors where we see the strongest job growth or the weakest job growth, you can see on the chart here the change in payrolls by industry since February of 2020, so since really the start of the pandemic. And you can see on the chart that leisure hospitality, so restaurants and hotels, really were hit hard by the pandemic itself, right? Those are person-facing occupations, right? There we saw the sharpest pullback in terms of travel, both business travel and personal travel during the pandemic. So within short period of time, we saw nearly half of the jobs lost within that industry as we went into lockdown. We've seen some good progress in restoring those jobs as people have come back to travel to restaurants and hotels, but we are not all the way back yet. And there's a case to be made that certainly a lot of business travel may never recover back to the prior levels, or may take a while to recover back up to the prior levels that we had. So there may be a permanent reduction in activity. We are making progress here, but still, leisure hospitality is the laggard, right? So as we think about small businesses and which industries they're in, that certainly is one consideration. At the other end of the spectrum, what we see is that transportation and warehouse jobs are expanding. We have more people working in transportation, trucking, and warehousing than we did prior to the pandemic. So that's just a testament of the shift, more online shopping, more virtual type of activity online in terms of purchasing and delivery of goods. And that certainly seems as though it's going to continue despite some return to in-person retail. Still, more and more of our activity is online, and we don't see that reversing anytime soon. Other industries are, as you can see, by and large, still below their prior pandemic levels, but they're making slow but steady progress upward here as people do come back into the labor market. Now, why are we optimistic that we will recover all the jobs we've lost and then some, including all the jobs that we should have been creating as we have new high school and college graduates and new immigrants into the country? Well, it's best summarized by this next chart here. If you look at the number of job openings we have in the country versus the number of unemployed, you could see that we are in a relatively unique situation in our history where we have far more people who are, far more job openings, about 11 million by our last read, versus the number of people who are unemployed, that is not working and actively looking for work. So about 11 million job openings, about 7.5 million people unemployed. So quite a large gap, which is atypical. Typically, it's the reverse. Typically, you have more people looking for work than job openings, but this just points to the amount of demand that is out there from employers who see a lot of opportunity, lots of demand for their goods and services, and they're looking to fill a lot more jobs than they have applicants for. So I see that going forward, more and more people will be rejoining the labor market, perhaps as some of the savings that they've accumulated run out, and that should lead to a continued expansion here. And that's a reason for some of the optimism I shared earlier on in terms of GDP and the unemployment rate going forward. So that's certainly the good news, that we have so many jobs available, right? That's definitely a positive. Now, there are lots of reasons why people aren't taking those jobs at the moment. Certainly happy to get into that if you care to ask the question. But let's take it as a given that for now, people haven't been coming back to the labor market for a variety of reasons. The consequence of that, a direct consequence of that, is that wages have gone up, right? You have increased demand for workers. You have limited supply. Not everybody's going back in at the rate that we would expect. Well, supply-demand imbalance there is going to lead to higher prices, in this case, higher wages. And you do see that reflected in the data here. That's certainly a negative for small businesses and their financial positions, right? Having to pay more for the workers that they employ, and having to post even higher salaries to attract workers into the positions that are open. That's certainly going to hit their bottom line. However, one thing to note is that the increases in wages aren't universal, right? It's not the same wage gain that we see for every occupation. There are certain occupations in particular where we see much stronger, much higher wage gains. And particularly as we look at the Atlanta Fed wage growth tracker data, we can see that many of the largest wage gains are actually in the lowest paying occupations. So it's actually in that leisure hospitality industry, for example, that we see some of the largest double-digit growth rate in terms of wages. So again, the impact of tight labor markets and increasing wages really does depend on who you're trying to employ or who you are employing and who you're trying to hire, right? Leisure, hospitality, hotels, and restaurants are facing certainly larger increases, are having to pay out more than perhaps some of the other industries, more professional services, for example, higher end, where certainly people are asking and demanding higher raises, but perhaps they don't have quite as much leverage as some of those lower wage occupations. So something to consider going forward. Expectation is that as we do move ahead, more and more people will be returning into the labor market, providing more labor, and that some of these wage pressures then are going to be reduced. Now, that doesn't mean that wages actually turn negative, that the wage gains are going to be lost. It's just that the rate of growth should slow as more and more people come into the labor force. All right, let me turn then to the household finances. Higher wages are negative, certainly for businesses and the small businesses that employ them. They have to increases their costs. On the positive side, it does put more money in households' pockets. And what we see is that household balance sheets are quite strong at the moment. So I'm showing you debt service ratios here on the chart. Total amount of our monthly debt payments divided by our after-tax income shown in the total debt line on the chart here. You can see that that is at a record low in the history of the data back to 1980. We add in auto leases and housing rent. So not everybody has a mortgage. Some people pay rent. You can add that rent back into that calculation, into the numerator, and that gives you the total financial obligations ratio. So it's a broader measure of all of our recurring monthly expenses. And even that is at a very low level compared to history. So by and large, household finances are in very good shape. A lot of that improvement is actually due to the ultra low mortgage rates that we have enjoyed over the last couple of years now during the pandemic. People have been able to refinance their debt and keep their monthly expenses low. So that certainly is a positive for households. And on top of that, what we can see in the data is that households have a record level of cash holdings or cash savings. They have actually a near record level of broader savings, or at least they did during the pandemic. That's slowly being reduced over time here. But they are sitting on a lot of cash at the moment. So here I'm showing you checkable deposits and currency by income group as measured by the Federal Reserve. And you can see across the board, across every income band, cash savings are higher today than they were in the fourth quarter of 2019. So that again is quite unusual coming out of a recession, that people would actually have more savings than going in. It's really a testament to a lot of the stimulus, financial payments, unemployment insurance benefits that were provided during the pandemic, and the higher wages I talked about. So people who are working are able to accumulate more and more. On top of that, during the pandemic, because of the pandemic, perhaps we were restricted in a lot of the spending that we might ordinarily do. We weren't able to go on trips, so that also led to higher savings. So this, again, is a reason for a lot of optimism going forward when it comes to the outlook. Households are sitting on a lot of cash, and as the economy improves, they are increasingly going to be willing to spend it. The other thing to note is that although savings are higher at the lowest end of the income distribution, they are actually pretty close to the prior levels. These are the groups that are going to run out of savings sooner rather than later, and that is certainly going to lead to a need to work and increase earnings in order to replenish some of the lost savings. So many of those jobs I talked about coming back in the labor market are going to be coming from the groups identified here. As those savings run out, more and more people are going to have to re-enter, rejoin the labor force. The good news is that savings provide somewhat of a cushion, so they might be able to choose a job or select a job where they can have a better match of their skills and interests. That should lead to some higher productivity going forward. All right, turning to small businesses and small business credit. The good news here is that small business credit remains quite pristine. Based on the Experian data, we look at early stage delinquencies, so 31 to 90 days past due for small business loans, lines of credit. What you can see is that the delinquency rates here are close to the bottom, right? So sharp improvement throughout the last 5 years, and this continues. So even though many of the support programs have expired, mitigation efforts have expired, the delinquency rates remain extremely low. So businesses are in good shape overall when it comes to their use of credit and ability to pay back. You can see that in the late stage delinquencies as well. So 91 plus days past due for small businesses, also near an all-time low in the history of this Experian data. So really solid credit performance here. We don't see much in the way of a credit issue um, when looking at the small business performance across geographies, across industries. There are some pockets of risk here and there, but by and large, businesses are in fairly solid shape. And this is backed up by the surveys conducted by the National Federation of Independent Business. We actually got another data point just this morning, which indicated that businesses overall remain quite positive on future prospects. In the chart here, I'm showing you the net percentage of businesses reporting their primary concern by different concerns. And there are a couple of interesting things to point out here. One is if you take a look at inflation, obviously getting a lot of attention, that is a rising concern for small businesses. It's not the number one concern. It's not the most popular concern, but it's certainly a concern for small business going forward. And a large percentage of businesses have indicated that they plan to raise prices going forward, given the inflationary environment here. What also is also interesting is that poor sales is not a concern at all, right? Or a very low concern. That's the pink line here. Again, typically during recession, you see this spike and it takes a long time to come back down. This time around, there's lots of opportunity for sales that small businesses see. The number one concern that businesses have at the moment is really around labor quality, being able to attract or fill open positions. A large number, nearly half of the small businesses survey, indicate that they have at least one job opening that they have not been able to fill. Right, so that is certainly a growing concern, is that the ability to attract quality workers to fill the positions that they have. And the labor costs, right, the fact that they have to pay more is certainly a growing concern as well, but it's not as important actually as just finding the right worker with the skills that are needed. So I find that interesting as well. There's perhaps enough pricing power out there, or businesses see enough opportunity that if they had the right workforce, they could see a profitable future on the horizon. Last point to make is that taxes is the second highest primary concern among small businesses, but this isn't really too much of a surprise if you look at the series. Small businesses are always concerned about taxes almost through any environment, so that concern remains. All right, let me conclude then with just a couple of comments around the greatest risks to the forecast, and then certainly happy to expand on any one of these or something else as we go into the Q&A. But we do maintain an economic risk matrix on our economy.com website at Moody's Analytics. So we're constantly looking across the economic horizon and identifying various potential shocks to this baseline outlook that I presented here. And we rank those shocks both in terms of likelihood on the y-axis and the severity of a shock on the x-axis, right? So you can have some shocks that may have a high probability, but in terms of the macroeconomic effects, relatively small. So a stock market sell-off, for example, we do view that as having high probability, just given the price to earnings ratios, for example. But given that stock holdings are relatively concentrated, the severity at the macroeconomic level may be somewhat contained. At the moment, the pandemic remains number one in terms of both probability and severity. Right, we still are beholden to the virus here in terms of our economic future. I mentioned that we are getting better at adaptation, right, in dealing with the virus, but if there was another variant of the coronavirus that did not respond to our vaccinations or boosters, or which was much more virulent, that certainly would take us back a few notches here in terms of both consumer confidence, business confidence, could lead us potentially into recession if it was truly uh, something we could not address or address very quickly. So that remains front and center. We saw the Delta experience where, again, the upward trajectory didn't fall, but it certainly was impacted. A couple of other key risks that I'll highlight are, number one, inflation. I think this is on the minds of many, and I mentioned small businesses are also keyed into the real risk of inflation should it continue or persist. You can see on the chart here a couple measures of inflation. I'm using the personal consumption expenditure measurement of inflation. This is what the Federal Reserve focuses on when setting monetary policy, so I tend to focus on that. I'm showing you both overall headline inflation as well as core, so less excluding food and energy. And you can see it's elevated across both of these measures. We have the highest inflation rate that we've had in the last 40 years. So that alone is a concern. The source of that inflation is what is the true question that we need to answer. Our view is that by and large, much of this inflation is caused by the supply side. So I mentioned labor market issues. We don't have enough people coming back in the labor force. I do expect that to change going forward. So that'll take some of the pressure off some of that wage increase that I mentioned. And then we do have certainly supply chain issues as we try to restart an economy that we shut down effectively for a few months. So that inevitably would lead to some of these supply chain disruptions. So I expect, and built in the forecast, is this idea that we will work through these issues, right? As we get more labor, as more countries are able to find ways to produce and ship goods around the globe, and that should lead to a slowing in the inflation rate in 2022 and back towards more of an equilibrium level of inflation of around 2.25% to 2.5%. So that is higher than what we had prior to the pandemic, but it is substantially lower than what we have today. So that is the baseline view. The risk, of course, is that I'm wrong about this and that inflation is much more persistent. Maybe people don't come back in the labor market in the numbers I'm talking about. Maybe supply chain issues linger a lot longer. If that's the case, then you'd have to consider one of our downside scenarios where inflation remains higher, and ultimately, at some point, the Fed would have to intervene very aggressively in terms of increasing interest rates to slow the economy, bring that inflation rate back down. I do think that they are committed to that. That certainly would risk a recession in that environment. Another risk I'll point out is asset prices related to a low interest rate environment. So we do see home prices, stock prices, cryptocurrency, name your commodity, at elevated levels. So that's the risk of correction certainly has to be on our horizon here in terms of a possibility. There's some good reasons why housing might have some support due to demographics, but given very high levels of house price growth over the last year, certainly certain markets in Idaho or Phoenix are more vulnerable to some potential retracement of the house price increases. So that certainly has to be on our watch list as well. Again, I don't see it as an immediate threat, but certainly under the right conditions, or if house prices were to continue to grow at a rapid pace for an extended period of time, that would be a risk. Finally, I'll end with some upside, right? I don't want to just focus on the negatives. One potential upside risk that I've mentioned on our quarterly call here before is productivity growth. All right, a silver lining in this pandemic is that a number of businesses have adopted new technologies that perhaps they have been putting off investing in, whether that's the video conferencing technology that we're using right now, or remote work. So we now have increasingly a national labor force to pull from rather than a regional labor force. That certainly should lead to better matches when it comes to labor market, more productivity. People are happier being able to locate wherever they like around the country and still work for their employer. So all of these types of technologies, cloud computing, AI, ML, whatever whatever you'd like, should lead to some permanent increase in productivity going forward. That will justify some of those higher wages and would also justify some of the higher growth going forward. So I am optimistic that the productivity will carry us forward here. But with that, let me stop. I'm sure you have a lot of questions that we'll want to get to, and let me turn over to Brody.
All right, thank you, Christian. Well, you know, it's always my pleasure to be here with Christian and to listen to the insights that he brings, and you know, just the excitement in just digging into the data itself. And you know, as folks that really enjoy this, and this is our job and our career and our passion to help small businesses and to help consumers gain access to funding. We find that this outlet, this thought leadership that's created, will hopefully help guide some of your insights as you go forward, looking for opportunities to support small businesses as we go forward. So I'm going to dig into a bit of what we're seeing across the market, and of course we dig into some of the consumer side credit data. First off, I like to look at consumers because consumers drive our spend for small businesses, and the confidence that they have in the market can really impact these small local markets, small businesses, and drive some of the supply chain challenges. You know, as their increased spend in the market picks up, we'll see the supply chain, the demand on that supply chain increase and increase, and we've seen that over the past couple months. Consumers in general, confidence has picked up this month, which is good. Well, it's actually pretty fantastic because it's been heading down to this point in a downward motion, as inflation had been really creating some pressure on some of that pent-up spend that you heard Christian talk about a little bit earlier. You know, consumers were pulling back a bit as Omicron picked up. You saw people less likely to get out and shop. They did a little bit earlier. And so in not spending as much, that need for additional credit wasn't really there. And we saw between Delta and Omicron, those two variant spikes, you'll see that we've had some continued growth in consumer credit. So different types of originations in both card and auto and you know, any type of a lending product that we see from a consumer perspective. Now, as the supply chain tightened a bit, you'll see some of these origination trends level off. We'll see some delinquency rates pick up just a bit, you know, as consumers are, you know, in some of our harder or higher risk tiers having a little bit more trouble making payments and getting to, you know, be able to buy the products that they really need. We'll see some increase in risk, certainly in those tiers. Now, when we evaluate consumers as a whole, we're going to see that some of the forbearance and payment modification programs are beginning to run lean. It's leveled off a bit. There, some of our commercial or consumer lending partners are extending some of the modification programs as we go forward, just seeing where we'll be toward the end of this year. But again, we'll see those continue to pull back as we get into our 2022 year. As we look across the different regions and we look at commercial expansion and contraction across small businesses, just wanted to give you a view of what we're seeing as far as those industries that are lifting and seeing growth and those that are seeing contraction across the US. You'll see several of those regions here. The blue indicates growth in those industries. The pink indicates those industries that are pulling back a bit. Where you see growth, something that Christian touched on as well, is that transportation and warehouse industry. So as we're trying to expand, we're seeing some challenges within the supply chain. Some investment is happening within these industries to grow capacity and allow some of that opening up of those pathways of product from mining, creating those parts and pieces, putting together the end product and getting it into the warehouse and ultimately into the consumer's hands. You'll see that process has impacted a lot of the growth that we're seeing across these industries, especially in commercial credit. Where you see it pull back a bit is in some healthcare services, certainly as we see some consolidation of those services, and then in construction, and also pulling back a bit as those different building materials have been elevated in their cost, difficult to get. Construction has slowed a bit, and that again, as Christian mentioned before, has driven up some of those home prices as well. So consumers have equity built up in their home. The challenge is that inflation is catching up to that cash that they have available to spend and that equity that they have in the home as we go forward. So just a different look as you look across the US on different regions and where we see growth and some contraction. Now, when we look also across delinquency rates regionally, where you'll see is the Northeast is a bit more challenged as far as delinquencies going, even from 2020, where we were in the heart of that recession, to 2021, where we're in that recovery mode. You'll see some differences in states where they've experienced a little bit more of the pressure during this period. Across the bottom, you'll see some of the stimulus programs, and I like to track these just to see where we are. Of course, the infrastructure package has passed. The expectation is we'll start seeing funding out for that in the first quarter, which will help some of these small to medium-sized businesses that are focused on supply chain industries. And that's important because those industries have been struggling to string it out until they can get to a place where some of the stimulus will certainly help them to continue to maintain and to grow as we go forward. So certainly looking at that in the next quarter. Now, as we look at delinquency rates are really low, and you saw the trends that were presented earlier where they're at historic lows after, from 2016 to the present, certainly historic. What we are seeing is that sloppy pay, or those early pay delinquencies, have maintained a pretty low level, and I like to look at these different vintages to see how they're performing throughout the year. And you'll see that 2021, again, for sloppy pay has remained pretty low, and that stimulus has certainly helped that trend to continue. Now, where I direct your attention here is to the mid-range, where we're in that credit card region of about 60 plus, where that bad definition comes in, where action, pretreatment strategies begin to take place for some of the higher risk credit cards that are available, certainly in a commercial space. And you'll see that those delinquency rates have been on the rise. So what that means is those that are rolling past the 30 days past due up into that 60 range are beginning to roll a little bit further down the pathway to a more severe delinquency status. And depending on where we go over the next 60 to 90 days, we'll see if those delinquency levels begin to level out. And that's certainly going to be, this delinquency pathway is impacted by our supply chain industry participants. Hopefully that will smooth back out as we get into the next couple months. Now, when we look at installment lending, I think this is a good key when we look at some long-term funding for businesses. We've seen that continue to grow from the midst of the pandemic, continuing growth over the last few months. It has pulled back a bit. Delinquencies have maintained a pretty stable level. You'll see in sloppy pay delinquencies on installment, these longer-term loans, that they've continued to decrease across all regions. We have seen the Southwest pick up a little bit. When we look at that Southwest region, there's some mining companies that are within there are driving some of that. And again, supply chains and industries within that region are also impacted here, and that's driving that up a bit. Now, one of the things that is good to look at when we think about origination and underwriting, and some of this is very concerning to you as you look to say, how can I grow? As we look at the risk in underwriting, what's being brought in and onto book, we see that it's been fairly stable over the past few months. So maintaining that risk level, those post-pandemic processes are in place, the criteria is in place, some adjustments are being made to grow, but the risk levels have maintained the same. So this is some of that machine learning impact on underwriting processes and automation that has been put in place to maintain the risk level, but try to dig a little deeper into some of the segments. But you'll see here that as far as what's being brought on book, fairly consistent over the past few months. Now, here's where I want to draw your attention to portfolios, because you'll see mining, certainly within our installment or a little bit longer term lending products, you'll see that that portfolios are becoming more and more risky, and that's a significant increase in risk. As you roll down some of the supply chain, you might look at manufacturing, wholesale trade, you'll see that these continue to go down or become a little bit more risky as we look year over year. So something to take a look at, and we're certainly going to see that as we focus in a bit more on unsecured lending. So when we look at credit cards for small businesses, so these are your commercial cards. We've seen a big pickup in the origination of these products. Commercial businesses are seeing some light at the end of the tunnel. They're starting to invest. They're reaching out to get new products. And when they do that, you can see the originations go out. Now, delinquencies have followed. That always happens. Delinquencies follow big spikes in origination. But they've been, again, historically low. You'll look at that sloppy pay and short-term delinquency, that 1 to 30 range continues to be low over the past couple years. So our expectation is we'll see that pick up just a little bit as inflation continues to rise, and we see that continued tightening on the supply chain. Those industries are really what is driving a lot of this increase in delinquency. Now, when you look again at the risk and underwriting, fairly stable. Here again is that look at portfolios. So within credit card portfolios, where do we see the most risk year over year? Where do we see that increased risk? You're going to look at some of these industries, so manufacturing, transportation, wholesale, retail. You'll see that growth in the higher delinquency buckets. These businesses are becoming a bit more risky, the accounts that are associated, credit cards associated with these within the portfolio. So the risk is increasing. The expectation, again, as we see the infrastructure bill come into play, we see some additional funding, stimulus-like, just contracts coming into the market. We should see some of these decrease. Again, small businesses have been ramping up for the holiday season, so I think we'll see some of that pay off as we get into the next 30 days or so. We'll see the results of that. Now, small business formation, if you're a lender or a service provider to a small business at this point, you've been aware of this statistic that's out there. Small business formations in the US are up significantly, over 70% from where they were a little bit more than a year ago at the beginning of the pandemic. As people are off of work or out of work, a lot of times that innovative spark picks up, and they're very interested in opening their own business or improving on a process that they knew before, so they start their own business. That means that businesses are out there, at this elevated level. We used to be at 2 million or so. We're at 4 million last year. We're going to probably hit 5 million this year in business applications. A little more than half of those will survive more than 12 months or so. But you have a lot of businesses out there seeking funding that have been in business less than 12 months. So very new emerging markets. A lot of this is underserved. That's in this segment. You'll see that identified as the pink boxes down below. That percentage of market has increased significantly from the pre-pandemic level. It means there are more small businesses in the market than there has ever been. And a lot of our lenders and traditional lenders that are out there will look at that, will not even consider making a loan to a business unless they have some history, at least 24 months to evaluate, digging in a little bit deeper. So some of the guidance that we've been giving to our partners is let's look at strategies where you can look a little deeper or look a little bit earlier at those emerging small businesses, look at both the traditional credit data that's available, non-traditional credit data as well, bring those together so that you can make some good risk decisions a little bit earlier, and certainly tap into this underserved market that is really going to be with us as we go into next year with the elevated number of businesses that are under a year old. Now, what have we seen within the supply chain? You know, we're going to touch on it at some point when we talk about small businesses. But as I looked even at the numbers this morning, we're seeing growth in factory orders. We're seeing inventories really improve over the last 2 months. Wholesale inventories are up significantly. What is making that consumer confidence number go up overall, when we look at the small business support of that, is that shelves have been pretty stocked. Inventories were over ordered during the summer, and as we got into Black Friday, and we saw that shelves stayed fairly filled as we went through the holiday season. We saw more shoppers get back out into the stores as they saw those shelves full, looking for that tangible pickup of a product or a gift as we're getting into the holiday season. Took a little bit of that shine off of online shopping and put it back in the storefront. And we saw some of our retailers really try to scramble to get a little bit more storefront space as they went forward to service the consumer demand. But that's been a good highlight as we've looked at just even over the past 30 days, seeing that improvement and seeing the elevation in spend of consumers feeling more confident to get out and do a little shopping. Now, what's going to impact some of the prices as we go forward on the supply chain, you'll see down at the bottom is the cost of shipping those products here from international ship into the international ports as we look to bring new products stateside. Container costs have been one of those that's been driving, and just the shortage of containers in general. You know, if we looked at, 2 years ago, you could ship something in a container for about $2,000 bucks from China to our port in Long Beach. That went up to almost $20,000 for a container. We're down to about 15 again, but still escalated above where they were before. That's going to continue to drive costs up for products as they become available stateside, but just something to maintain. What is good is that our wholesalers and retailers have stayed on top of that ordering. Some of our big boxes have purchased their own ships and planes to make sure that that continues, but we are seeing some good activity there that is helping to subvert some of the challenges and consumer angst over what would be available on the shelves. That's good, some good progress within the US. When we look at lending activity, just in general for the supply chain contributors, I think it's a gift to us. I put a Santa hat on here because I think it's a gift that we've seen continued activity. You see this positive trend upward. That means that these industry participants are looking for private funding and are really trying to grow their operations to keep up with the demand that's been there. Now, what we'll also see is that as we ended the summer and we got into the fall, that delinquencies were on the rise. Some of that was concern as we got into this time, is would we be able to get trucks out of ports? Was there an opportunity? Kind of a pulling or floating, I guess, some of the delinquency as we got into the fall time period and into this shopping time, but I think those delinquencies should calm a bit as we get through December and into January. So certainly some positive progress as we've gone forward. Now, as I kind of look at what we've talked about today, I think the big points to bring out is that we're going to see these COVID outbreaks continue. If we looked back at influenza patterns, we look at COVID now, these pandemics last for several years, and we're about the second year of the pandemic now. It will probably continue for several more years, and we'll build that into the pricing of our products, these ebbs and flows of participation of consumers with small businesses, and that will continue to move forward. I think we're also taking on some practices that will keep us safer, keep the consumer out there and shopping, just taking added steps. I'm going to put on a mask to go out today. I feel better in doing that. I'm going to continue my spend activity and engagement with the market. Commercial businesses will feel that same way. I have safety practices in place. I can continue to process, and I don't have to shut down operations as these spikes continue. So I think that will be good as far as the progression as we go forward. Now, we will see some delinquencies elevated. as we get into next year. What that will, as we see the labor market kind of level out, we see businesses that either survive or don't. We'll see a lot more consolidation of small businesses. You know, as supply chain squeezes, the big businesses are able to get in there and create contracts. They can swing their weight around and get inventories in easier than small businesses. They really have to fight to find that inventory input. So we'll see some delinquencies rise, certainly for small businesses as they compete with their larger competitors as the market continues. But that is something that we expect to see certainly into the first and second quarter of next year. Fraud's going to pick up. You know, we're seeing new businesses in the market. You know, we showed the metrics a little bit earlier that they're rising in the percentage of the overall market participation or new businesses from 0 to 12 months old. What that means is that fraudsters are going to target these folks because they don't have all the security practices that come with a more established business. So fraudsters are going to target those folks a little bit more. You know, as we're evaluating the way that we interact with them, or the way that a lender might interact with a small business or a consumer, having those fraud solutions in place just to evaluate, make sure you're talking to who you think you are, and to ensure that you know, the partnership that you have between you and that entity is a strong one. And so as we go forward, that certainly is important, but we have to remember customer experience. So as you're evaluating processes and taking on business from either a direct-to-consumer process or with your small business owner, they've been in that stay-at-home mode where they're interacting with you digitally. They'll expect that same customer experience and that quickness of a decision. So evaluating solutions and fraud solutions and onboarding automation is going to be a continued advancement and an effort for our partners, and even the way that we interact with the market to continue to have that customer experience at a very high level, even when folks get back out and shop in person. So to wrap it up, I would say that we are in a good space as far as the U.S. market. We certainly are progressing in a positive way. Our lending markets are expanding. Our delinquencies are raising just a little bit, but are still at historic lows. We're seeing some support coming in from different stimulus packages that will help small businesses as we get into the next year. And I think our outlook is pretty good as we see the Fed having some additional confidence in how well the market is engaged, how well we're doing as far as a growth perspective, and we'll see some tapering begin and potential for rate increases next week, which means that they also feel that we're headed in a very positive direction. So I'd say very positive general overview from what we see from a small business and consumer, and just from an economic overview in general. So Gary, why don't we open it up, see if we can get a question or two from the audience?
Yes, by all means, folks, if you want to submit questions to the panel, you can do that from your GoToWebinar tool set. I had more of a curiosity, a question of my own about the infrastructure bill, and when we're going to see that kind of trickle down to small business. You know, a lot of the infrastructure investment that's in that package is going to be roads and bridges, and obviously there's construction companies that are going to be doing that. Is it mostly like the large construction investments in telecommunications? That's big telecom, right? Is small business going to see some benefits to that, and when could we start to see that infuse into the economy, Christian?
Yeah, great question. So a couple things to highlight here. First, infrastructure is always a complex endeavor, right? So this is not like the stimulus package we had earlier this year or last year in terms of just putting an immediate set of checks into the economy, to people's pockets, right? These things take time to design and plan and actually hire up for, right? There really is no shovel-ready project out there, as much as politicians might like to talk about it. So I don't see this as having a real impact on the economy until 2023, at the earliest. I think 2022 we continue to plan. There will be some bidding that goes out. Maybe we start to see some pickup at the end or later half of 2022, but nothing immediate. In terms of small businesses, I think largely they will be impacted through some type of trickle down, right? There'll be some outsourcing from perhaps a larger entity that gets the main contract for these large projects, for example, and then they'll parcel out some activities to smaller businesses. And then really there are a lot of support businesses that benefit from this type of spending, right? So you have construction workers out there building the road or fixing the bridge. Well, they need hardware stores, they need suppliers to help them to provide all the materials that they need. They need restaurants, they need food, right, on site. So I see a lot of the small business activity actually coming through those other indirect channels versus actually winning a contract itself, just given the scope of many of these types of projects.
Mm-hmm.
And for that reason, I don't see this as being terribly inflationary, which is a concern on the minds of a lot of folks out there, because I think these projects will be scattered out or spread out over time. It's not going to be an immediate hit to the economy. It's certainly not anytime soon.
Yes. We had a question about inflation from Fred. His question is phrased 4.5% GDP growth. In that, I think he said, is that including the 3% inflation? So 1.5% actual GDP growth in units, or would you say 4.5% to 3% equals 7.5%? I'm not sure I got all of those numbers right. What?
Yeah, just at a high level, I think the short answer is I quoted real or inflation adjusted GDP, right? So that's already accounting for those inflation. On a nominal basis, our GDP is even higher than what I described, just given that inflationary effect. So yeah, typically we look at real inflation because we're trying to compare year over year, and we want to account for the fact that inflation is higher or lower in certain years.
Very good. There's one question here. I'm not sure we can actually answer this one accurately. From Rodney, he asks, can you say anything about the small business outlook by race or diversity? Is the outlook positive across the board? I don't believe in this data we address that, do we, Brody, for Main Street?
We did not address it in this data, and I think that, you know, as we've looked at pre and post pandemic inclusion projects and what we see as an overall market, we've seen that equity has been improving across small businesses, and certainly some of the stimulus programs focused on that exact point, that the expansion of those underserved groups was really a focus of where the funding would be placed. I think we have seen some improvement there. Some of the future studies that I'm sure Christian at Moody's and Experian will be doing over the next 30 to 60 days are going to continue to highlight those. We certainly have some as part of our thought leadership that it's available. But you'll see that it is improving, still at that 20 to 25% inclusionary mark, certainly for small businesses in the minority segment, but that continues to improve as more and more of our businesses or lenders are out there really focused on helping these communities. And, you know, if we can plant or make visible some of these consumers that are underserved and small businesses that are just mom and pop shops, very small, and we can help them to be identified, rank risk, and put some funding in their hands, that helps more than just that small business. It helps that community. So we're certainly focused on that. It's a big part of what we do at Experian. I would just say that it's in a positive direction at this moment, and we can certainly share more metrics with you as we continue forward in this type of environment.
Excellent. Well, I want to thank you guys for coming on and sharing these great insights with us again this quarter for the Q3 data. We would like to thank everyone else for coming today and giving of your time and listening to the presentation. Thanks, Christian from Moody's, always being a part of this, and Brody from Experian. And when you close the webinar, if you could do us one big favor, if you could let us know how we did, it really does help us improve our webinar program. And we really would appreciate your, it's just a very short survey if you could fill that out. and also look for a follow-up email from us. For more information on Moody's, of course, you go to moodysanalytics.com. And then for Experian, you know where we are, experian.com/B2B. But I want to wish everyone happy holidays for 2021. We're going to see you in 2022. And that'll be it for today. If Christian and Brody, if you could just hold on one moment.